Good afternoon, everybody. Welcome to today's live streaming webinar from A&D Mortgage. I'm Carl Holman, communications manager here at the company. Today I'm joined by Renzo Echeverria. He's one of our top account executives. Today's topic is going to be a deep dive into non-QM loans for self-employed borrowers. Renzo knows the waterfall of non-QM programs that are applicable for these particular types of borrowers. So we'll get to it in just a second here. Let me throw the PowerPoint up, and then I'll introduce you really quick. All right, so very quickly, let's go over the ground rules as usual. For those people who are watching us on Facebook, LinkedIn, Non-QM Exchange, and YouTube, you can put your questions into the comments section. It'll aggregate and we'll be able to see the questions and we'll answer those towards the end. The other thing I would ask is if you've got a cell phone, just turn it off for the time being and give us your full attention while we're doing our presentation. And we'll try to get to the questions towards the end. All right, so Renzo, why don't you tell us a little bit about your expertise, how long you've been with the company, so that people can understand your perspective.
Well, my name is Renzos Background, National Account Executive for AD Mortgage. Been with the company for approximately about 2 years with a 30-year background and mostly in operations for about 25 years, working with some of the country's great lenders. My expertise is probably would be in funding and underwriting, and the underwriting portions allowing me to understand the different types of income and how they can be applied to many different types of self-employed borrowers.
Okay, great. All right. And then again, since this is for a wider audience, there may be people who don't know who we are as a company. So why don't you give people a little bit of a background of who the company is, where we service, and all of that.
Well, AD Mortgage is a family of companies bringing the right programs to the industry. We are a direct lender and servicer offering conventional government and non-QM as well as bridge loans. We are currently expanding nationwide rapidly, bringing our non-QM, our business type loans to different parts of the country, approximately about 35 different states now. Bringing our products to a wide array of brokers. We also are supported by our Imperial Fund, which was developed in 2014 to help us with our non-QM hard money and commercial type applications, which you'll be seeing in the future.
Okay, great. Thank you. I noticed we didn't have the footprint slide in here, so I'll post that up for people who may not be aware. All right, so let's cover really quickly, kind of high level, the different types of programs that we offer to our essentially our self-employed borrowers.
Our non-QM products income types include actually the first one would be 1 and 2 year full doc, which would be with the 2-year tax returns, and also 1-year tax returns, which will come into play a lot when it comes to the beginning part of the year, where you can analyze the previous 2 years tax returns and then make a decision. And we actually have a product in which we offer 1-year tax returns, which will help you between the months of January and March when you're actually sitting down with accountants and helping borrowers file their tax returns. Should your tax returns not be able to work and you can't get the debt ratios needed to qualify for those type of products, that's going to be a great time to look at the 12 and 24-month bank statements. As you notice here, our FICO start around 600. Please keep note and watch as FICOs have been changing with the fluctuations of the market, and we're currently at 85% LTV on these type of products. Also in review with our secondary market, we're trying to see if we can go ahead and play with those values. We go cash out up to 80% with $1 million in hand, and there's no limit if you go up to below 55% LTV. Great thing about our products is we only require 3 months reserves on all our non-QM products except for the foreign national. And also note that we have condos up to 85 and condotels have been recently added to the approved type properties. If your bank statement should not work out, let's say maybe you have some NSFs that exceed our guidelines and matrices such as that, the next product you're going to want to look at is going to be your 1 year or your 2 year P&L. Please note your 1 year P&L will get you up to 80%, and 2 years, the more income you provide, the more we'll able to lend, and also the lower the interest rate, you'll be able to go up to 85% LTV on that. In certain LTVs and purchases, max DTI can be up to 55% with loan amounts up to $3 million. P&Ls are prepared by a CPA, but they can also be prepared by a licensed tax professional or someone that has been registered with the state to be able to prepare federal tax returns. No bank statements required, and this is offered on our Super Prime and our Prime programs. Not necessarily for our self-employed borrowers, but we want to keep in mind the written VOE and the 1099 aspect is probably where it plays in, which is a great program in which you can probably offer up to realtors who may tend to be self-employed subcontractors. This is a great program that can get you loan amounts up to $3 million. 75% of the 1099 income, and we'll get more into the details about this program further along in the slides.
Okay. Yeah, Renzo, you mentioned something really good that we actually glossed over before we jumped into the programs, which is we talked about the realtors who are self-employed contractors, which begs the question of, obviously, why do these programs exist specifically for self-employed borrowers? What is it about being self-employed that makes these programs need to exist?
Well, if we just look recently back in our history, we'll note that when COVID first started, we literally stopped financing to the self-employed community for about maybe 16 to 18 months. Literally, a lot of our guidelines in the Fannie Mae, the Freddie Macs, also the non-QMs, we basically sat back and go, wow, the whole entire country shut down. All the self-employed borrowers are no longer working. They're no longer generating income. So we came out of that realm, and with a little bit of our education back prior to 2008 with the subprime industry, we started analyzing and found that within reviewing other types of documentation that we would be able to, per se, give our underwriters a warm and fuzzy feeling as to the borrower's ability to repay the mortgage. As long as our secondary markets are able to receive payments on a monthly basis, we're able to keep our investors happy, keep the rates as low as possible, and provide our self-employed borrowers with different options of being able to prove to us they are currently making the income and are going to be able to fulfill their obligations on their liabilities, whether it be residential or revolving credit.
Okay, and also to just the general trend or shift in the labor market, where it seems fewer and fewer people are working that standard old 9-to-5 job for a corporation where they get a W-2 as a standard way of documenting their income. You got more gig workers, particularly amongst millennials, Gen Z. So that's another larger social change that has sort of caused the need for a lot of this. They just won't qualify under, like you said, Fannie and Freddie guidelines that want W-2 income.
Well, actually, as a great example, when it comes to the self-employed borrower, especially in this country, I would have to look back maybe on a loan that I just finished closing that was on a 12-month bank statement transaction. This was a line cook. He got fired from the restaurants because all the restaurants closed down, which everybody knows that story. We've seen it all across the news. And then we're sitting down, and he got together with his cousin and his wife and so forth. And they literally started a street vending. They got all their permits and so forth. And when I started reviewing their bank statements, the gentleman was cashing in approximately about $150,000 to $200,000 a month. Therefore, if you looked at his historicals for the past 4 years, he literally quadrupled his income by being let go, which has to be the American dream. To be able to go from a wage earner to being self-employed and actually improve your whole entire family situation out of a traumatic experience.
Yeah, great. A good example. Okay, so we covered that. So let's take a little bit of a deeper dive into the bank statement programs. I know you gave a high-level overview, but we can look at the differences between personal and business, some of the ownership qualifications around the bank statement programs.
Well, personal bank statement programs is one of those in which we have corporations in which they have all of their accounts set up. And what we're looking for is we're looking for the income that the borrower is personally making. So 100% of the stable deposits are going to be used for the income. And for pricing purposes, we'll take those on a 12 or a 24-month bank statement average. When it comes to personal bank statements, we'll allow up to 2 of them to be used for the qualifications of the loan. They can be accepted from thrifts, credit unions, and regulated institutions. Only the business income that is being generated onto the loan will be used for the personal bank statements. Now, what does that mean? Let's say we have a personal bank statement and we have all this income coming in from the borrower self-employed, but he happens to be on the loan by himself. And we have W-2 income from the wife going into the same personal bank statements. What we'll do in those aspects is we'll just take the wife's W-2 income out, take all the line of all the deposits, and then average that over the period of 12 or 24 months would be a good way of explaining what type of incomes we'll consider or not consider. And then when you're going to go ahead and complete your 1003, we're asking that when you complete your income analysis sheet, that you give us the total number of average deposits for all the 12 or 24-month bank statements. And then our underwriter will go ahead and decide how much of that income per program will be used for the qualifications of the loan. So if these are strictly only personal income, personal bank statements, we will use 100%. Or per se, if it's a commingled account, and then the underwriter may have to reconsider that, take out the business income from that, and just calculate the personal. But that's a good time in which you're going to want to call out to your account executive, sit down and review the details of your statements.
Good. Okay. And then let's talk about how it differs for businesses.
Well, business bank statements are going to look at kind of with the same frame of mind. The only differences are going to be in which you're going to be looking at all the deposits, but you're going to really be focusing on the type of deposits. You're going to be wanting, again, to use only the income that the company is generating. So a good definition of that would be, we will be removing tax refund checks that you may see as deposits that may be of large amounts. In the past 2 years since we mentioned COVID, you may be noticing SBA loans. Those will be subtracted out because in nature, those are not income. That is just a loan that they received. Another thing that you might see besides those, you'll have SBA loans. Again, sometimes you'll see rental income going into these bank statements, which would also be removed, and that would be calculated in the schedule of real estate separately. So you would take all your deposits and then you'll divide by 12, and that's the income you would go ahead and use. You're allowed to use up to 50% without us really asking you how much is your expense ratio on your company. If you're looking for more than 50%, we again allow you to go ahead and seek your CPA or certified tax professional to provide a profit and loss, allowing us to know how much of the income that we're used towards the qualifying of your loan and how much of that income would be used to run the company. A good extreme example would be I had a set of tax returns, 1-year filings, and we were trying to look for it was a 12-month bank statement transaction, and we were trying to figure out how much income this individual made, and it turned out it was actually like 95%. The gentleman was actually running an online company in which he provided GPS tracking systems for the weather for coffee bean growers and different farmers across the Caribbean islands in South America. So when we looked at his P&L, it was so minimal. He had internet bill, he had a cell phone bill. Now you ask, how is that possible? Well, we went ahead and we provided a copy of the webpage explaining the nature of the type of business, the product that he sold. But the manufacturer actually manufactured everything and drop shipped everything to the locations. Therefore, we had no need for warehouses, no need for secretaries, no need for a whole entire infrastructure. And he was literally able to run this whole entire company in boxer shorts off the computer. So in this day and age, with all the technology, we really have to take closer looks at not only what individuals do, but how they do it, because the internet has provided new income streams that allow different ways to look at how a person will actually generate the income. And this, like the personal income, you're going to want to put the full calculation of your income worksheet on a 1003, and again, allow the underwriter to make their calculation based off your P&Ls and your other supporting income. Also, another thing about business bank statements is not on this screen. So I'll explain further about the percentages of ownership.
Well, hopefully that borrower wore pants to his closing. Well, you had mentioned the SBA loans. What about PPP loans? Have you seen those
Uh,
mixed in yet?
The PPP loans, you will see them mixed in. However, we're not going to include them. Again, they're loans. So we're looking for just a generation of income and deposits and what's coming from them.
Okay. All right. So let's move over to the business ownership requirements that you were mentioning earlier.
There we go. I was getting ahead of myself. Apologies. Borrowers do not have to be 100% of the owners. With our limited liability corporations and different type of self-employed filings, only the borrowers that have 25% of ownership or greater must be disclosed on your 1003. Those less than do not have to be disclosed. When it comes to like the number of borrowers on a transaction, you can only have up to 4, and that could also help for, let's say, the one that has the leaser percent of ownership might also have a leaser FICO. Another reason why you may not want them on the actual application. The verification of the borrower's ownership you can find by third-party verification. I usually recommend just reach out to the Secretary of State websites and then go ahead and download their statement of informations and articles of incorporations, or your CPA would also be able to identify the percentages of ownership as mentioned in the previous screen. And then the only other requirement that we're having for business ownership is that we would like them to be stable and employed for the past 2 years.
That would be good. All right. Okay. And then I know the next type I think we're going to talk about were the WVOEs, 1090, concierge service. That's one of our key highlights.
Well, we have a concierge service that we have available for all our brokers, since these are new programs, and the way we look at bank statements can sometimes get confusing as to whether we will accept a large deposit or not. We allow you to send your bank statements and upload them to our concierge service by just going ahead and completing the items that are listed on the screen. Go into the services, and also I would add that if you have a complex set of bank statements, that even though you're sending these to the concierge service, review these with your account executive, so that way, like let's use a real estate professional again. They're a good example because we have many different types of real estate professionals. We have real estate professionals that are closing 2 or 3 closings every single month. We have a couple. I shouldn't say a couple. We have a fair amount within the industry that could actually survive with 2 closings a month if you're in your higher cost districts. If you're, let's say you're selling homes in like Beverly Hills, Bel Air, the Hamptons, and you have like 2 deposits a year, but those 2 deposits are like $60,000, $80,000 a month. In those instances, let's do a double shot. We're not going to exclude them because it's a one-time large deposit. Provide a copy of a HUD-1 or document those large deposits. Maybe they're outside of the industry. Maybe they're contractors. Provide the nature of the source of that large deposit, so that way the underwriter understands what she's looking at and reduces the number of conditioning that you have on your approval, therefore reducing the number of days that it takes you to close, getting you a better referral service by just knowing your transaction and what the underwriter may or may want.
Yeah. That makes sense. All right, so now we can talk about VOEs. Nope, P&Ls.
P&Ls. Like we were saying, since we started off with the bank statements and I mentioned earlier, NSFs. When you're reviewing your bank statements, don't only review them for just the mere deposits, but also review them for your overdrafts and your NSFs and your derogatories. And also maybe they have a different typesetting that they may be missed. Know your client situations. 3 NSFs per transaction is guideline. Up to 7 is an exception. Anything above 7 would bring you to your 1 and 2 year P&L program. So we would not be asking for any bank statements on these transactions. And then we can go down to a 600 FICO with an 85% LTV with 2 year and 80% on 1 year. As I mentioned before, the more you provide us that make our underwriter more comfortable as to your ability to repay, the more we're able to lend and lower the rates. Max DTI on your purchases are up to 55%, loan amounts up to $3 million. And again, your P&Ls have to be prepared by a CPA or a licensed tax professional. So that could be a massive difference in how much they're going to charge you versus a CPA or a professional that completes tax returns on a business basis. And these products can be provided on your super prime and your prime programs.
All right, well, let's go. Now I think we're going to talk about VOEs. Yay! Finally get to talk. We get to talk about these.
Written VOEs and 1099s. Because there's taxes can be very complicated, as we said earlier. It is the whole game of converting write-offs into income, a language that's up to interpretation as we have our tax laws change on a yearly basis, depending on our presidencies and IRS. So we provide written VOEs and 1099s, and what we're looking for is for 2-year stability. Same employer. You can go ahead and provide a pay stub with a year-to-date or a completed VOE that provides all the income earnings for the previous 2 years. We're looking to verify that you have no mandatory expenses when it comes to these. And when we get into the expenses, it can be written VOEs such as 2106s, or it can be also 1099s, which also can be somewhat contractor, somewhat self-employed, where you have your own expenses. Traveling nurses would be a good example for a 1099 as well. Some traveling nurses will incur flights. They have to bring their own tools and so forth. They have to provide their specialties, and that would go ahead and incur onto their profit margins. Other contract traveling nurses will have everything supplied to them by the operating hospital. So it will be many different ways and many different type of structures within the same type of employment, income type, and job structure. But your pay structure could be completely different. So that's where we're looking for the letters from the CPAs and the tax professionals to give us more of an idea that you're not exceeding 50% of your income as expenses and so forth. And in that way, we can go ahead and provide the proper income so that our underwriter will know how much funds will be available for the repay of the mortgage and the revolving credit that your borrower has disclosed. These minimum down payments can also be used by gift funds. And so check your matrices for those as we allow different options.
All right. And what about, let's talk about people who don't need any of these because they are very liquid. So these will be
our trust fund baby.
That's right. No, that's right. We took out asset utilization, so we don't need to talk about that. Let's jump over to loan scenarios then about these particular types of borrowers.
Okay, so we have a commercial developer at 700 FICO, cash out $2 million, 50% LTV, clean mortgages for the last 12 months. We have an executive summary in lieu of additional deposits, 12-month bank statements, owner occupied, and 0 times 30, as I mentioned. Okay, so this was kind of like the scenario that I was using previously with the realtors in Beverly Hills. A commercial developer would be in the same type of situation. They have contracts, they write them out. Usually their builds are between a year to a year and a half in duration. Sometimes they have split deposits written out in their contract where they'll receive like 4 lump sums according to like permitting, infrastructure, inspection and completion, and maybe you'll only ultimately have 2 deposits in one given year, depending on the calendar and what you're writing. So when supplying your 12-month bank statements, it could include 12 deposits. It can include 2. So that's where we look for the executive summaries and or P&Ls to kind of explain the nature of the deposits on this. And that way we'll be able to validate the income and the debt ratio that'll be applied towards this borrower.
Yeah, I think we also did another one that we looked at was a P&L, I believe. No, it was another bank statement.
So bank statements are going to be pretty much a similar way. You're going to want to take all 12 Basically break them out into one bank statement at a time, go ahead and itemize all the, usually the way we specifically do it and the way the form calls for it is you go to page one, add the total monthly deposits. Then next to it, you just go ahead and start entering the fields of items to deduct, like your interest credits, the SBAs, the tax refunds, and you start the transfers that are not acceptable, and then you get the lump deposit for that month, and then you do that 12 times and tally them together and add that for the 1003. So with these type of self-employed borrowers looking for refis and cash outs, that's how we're able to use the 12 and 24 month bank statements, because we're able to see the flow of income and understand their lifestyles. It's amazing what a bank statement can show you.
Yeah, it really is. Okay, so now is when we sort of will normally cover our questions and answers. I'm not seeing any come in yet from Facebook or YouTube, but if people are watching, go ahead and again put the questions in the comments, and we'll go ahead and post them up and answer them. So, what are the most common questions that you typically get about these particular types of programs, especially if it's a new broker who hasn't been involved with non-QM? Do they think it's subprime? Do they think it's shady? I mean, what's your sort of usual new broker finding with these programs?
You have different aspects of that opinion. You will take the more seasoned group of brokers that have been doing this for like 30 years, and you have two different aspects. You have those that got into the non-QM or the subprime sectors earlier on, started learning more about it, and within their learnings, they started finding and realizing how the underwriters were looking at it in order to make a sensible decision. Some used to look at them as less than favorable, and then as now we have more traction, we have more of our securitizations going through, and the economy is starting to see how these borrowers are making their payments on a timely basis, that they are per se buying in. We also have a new group of individual entering the market that have a shotgun fear from 2008. These people do not understand the non-QM, and it's more of an educational process. It's like we're not necessarily taking their word. If you go ahead and you look at these bank statements with me and follow along, that we're looking at their deposits, we get a complete view of how they're spending their money. We're comparing that to the credit report and how much money they have left over in their deposits. There's a lot that it's not that we're just looking at the deposits and then the P&L. Underwriters are looking at the whole entire picture, your assets, your reserves, and when putting all this information together, we truly nowadays, with our technology, our fraud guards, and many other tools that we have in the back office, when we put it all together, we're able to make a nice, solid package that any person in secondary will be able to review and have a warm, comfortable feeling at what they're reviewing, that this borrower is going to be able to make their payments, which is ultimately what's going to be able to go ahead and start driving down these rates as people feel, as these become more mainstream and less niche per se.
Yeah. Plus in the current environment where you've seen escalating home prices for several years, you've pretty much maxed out a lot of the Fannie Freddie conforming loan limits. I know a lot of lenders, including ourselves, the last week or so have been increasing their loan limits on conventional products. But even then, in higher price markets like you said, the Hamptons and California, even a high balance conventional may not touch in some of the areas where like a $2.5, $3 million property, or they need that much to borrow. That
That's
most
a
of
good
these.
point you make when you're looking at those areas regarding the high value areas. That one thing that we have in non-QM is a 55% back-end debt ratio. When you look at prime lending, typically you're going to want to be in a 43% back-end debt ratio.
Mhm.
That's a good point as to, well, why can you do this? Well, if you're doing a $3 million transaction, or maybe a five or a seven, and please note that not, as I mentioned earlier in the presentation, that we are direct servicer and lender, that we are able to make exceptions on higher loan amounts. And the reason why we're able to do that is because a person buying a $300,000 home at a 55% debt ratio is not going to have the same residual income as a person buying a $3 to $6 million home. That 45% ratio of income used for expenses, that's a lot more money to use. So
Yeah.
we're putting into perspective the total amount. And that's why on loan amounts over 2 million, we've learned that a 55% back-end debt ratio is not so extreme because they have a lot more income to play with. And those are the things that we're learning with time.
Yeah. And what do you advise brokers in terms, because you had mentioned borrower education, particularly for those people who maybe grew up during the 2008 housing crisis and saw perhaps their parents got foreclosed on or something like that. And now they're in that age range now where they're probably likely to be a first time home buyer, maybe a first time investor, um, about helping brokers to educate borrowers in that realm about particularly these types of programs.
I would probably almost recommend that individuals start going back old school. Go back to your realtors, start putting home buyer seminars.
Hmm.
Um, like I had a story in which one of my brokers likes to go down to USC and give presentations. And he was sitting there in a big old conference room with about 300 students, and he was giving his presentation on purchasing properties, and all the kids were doing their homework, they were writing, and he was like 5 minutes into his speech, and he just stopped.
Hmm.
What's going on here? It's like everybody's somewhere else. And one kid raised his hand and goes, okay, it's 2009. Half of the people in this Coliseum have lost their homes. We are all coming out of college with nice, hefty 150, 200, $250,000 student loans. And you're talking to us about buying properties, and what the smallest 900 square foot home down the street is worth 900,000.
Hmm.
No one in this room knows who you're talking to. Um, Now we have even more culture shock, in which now, at least back then, we had 3% interest rates.
Yeah.
Now the values are still 900,000, but now we're at
Five,
5 to 7s, depending on whether you're institutional or non-QM sectors.
6.
So what I would probably
Which is
recommend
still
is,
historically lower than we were, 20, 30 years ago.
I started in the 90s and I was 18 years old in 89, and I was sitting there freaking out. It's like, oh my God, it's going to be 9%. It's going to, they're talking about tens. And then the guy in the back office sits there and goes, you should remember, I used to have a 13.
18.
And the other guy behind him said, oh, I had an 18% mortgage.
Yeah.
It's evolution. Granted, the scenario I have for that is like, yeah, they had a 13% loan against the property down the street that was worth 350. Now we're going to go ahead and do that same 8.5% against a $3 million property. That's 900 square foot property, because
Yeah.
it just happens to be 2 feet away from the beach. It used to be marshlands before. Now it's prime real estate beachfront property. So times have evolved. But time also has technology. A lot of these kids that were like very shocked as to how to purchase a property are now getting into TikTok, all these mainstream computer engineers. I know
Hmm.
my nephew is a nuclear scientist right now, and he just got out of college, and he's right now building our nuclear defense system. So these type of kids are coming out, and they're also trying to enter into the real estate market and
Yep.
provide a home. They're still a little scared what happened to their parents in 2008, and teaching these individuals, like with the 1099s, the bank statements, and the different multiple ways. Start teaching children that are getting into graphic design, educate them into start opening up their corporations and opening up their Schedule Cs, do their filings, get their business set up now. So therefore, as they start working their business in about 2 years, knowing how to deposit your money, how to spend your money, where to put your money will help these kids enter in the marketplace that we have left behind for them in the real estate. That's what I would recommend that people start doing, because a lot of the
Mhm.
realtors, well, actually, a lot of the loan officers from all the conventions I've been doing recently
Mhm.
don't even know how these products work. So I cannot imagine that the realtors would know better than the loan officers would, and maybe turning away transactions that may be a little bit different in income structure, but still
Mhm.
be a viable purchase.
Good suggestions. Okay, I'm still not seeing any questions coming in from the social platform, so I'll go ahead and head up on the wrap up slides, and we'll probably finish up. Okay, so for those people who, again, may not be familiar with some of the things that we do, there's a number of ways that they can stay engaged with Andy Mortgage. You can go ahead and let me talk about Quick Pricer a little bit. Um, as you had mentioned, so brokers can use our Quick Pricer, which is available on our website. They can basically run scenarios quickly, and everything on the Quick Pricer, and I don't have the time to demonstrate it, is very simple. You can type in FICOs, loan amounts, adjust for things like borrower or lender paid compensation, prepayment penalties. There's some oddball state exclusions, and then instantaneously get a fairly accurate quote for their borrower of what their monthly payment could be, along with a interest rate, and you can make some adjustments there in terms of whether you want to buy the rate down or not. So they can do that.
Well,
Um,
also, we just added the 15, 30, 45, and 60-day pricer that just went up yesterday.
oh, I wasn't aware of that. All right, I'll have to make an announcement on that. Okay, and then we have the appraisal center. So if our brokers are starting to work with us and they're at the appraisal stage, we have more than 20 approved AMCs, so they can go ahead and do all the appraisal orderings straight through the appraisal center, manage everything in one platform. Um, if they don't have access to any marketing tools, we have an online marketing platform, functions similar to Canva. We've got hundreds of preloaded templates for flyers, postcards, social media posts, pretty much at this point anything you can think of. And once they've got credentials and load in their company's information, color palette, photo and logo, then they can just go choose a palette. It pre-populates, and then they can just tweak it a little bit here and there with a new photo or move text over a little bit, and you can have a professional grade materials pretty much instantaneously. And it works on desktop, mobile, and tablet, so it's good for on the go as well. We do these weekly webinars, so we've got quite a few of them coming up. So next week, there's a new potential pipeline for mortgage brokers who might be interested in getting into correspondent lending. So we're going to take a look at that. There'll be some additional information coming out throughout the course of the week if there are people interested in doing correspondent as well. So keep an eye on your mailboxes if you are subscribed to our mailing lists. If not, go to our website and subscribe, and there'll be some good information coming your way. We've talked at great length about non-QM, but just so everyone knows, we also are a full service lender. So we do conventional and government loans. So we'll take a look at those just as a reminder for our broker community that we do more than just non-QM. And then if people are regular members of our community, they may be familiar with our weekly A&D Market Digest. We just sent another one out today. And what that is a weekly wrap up or review of the economic market news that has happened over the past 7 days. So we'll interpret how that data, whether it's consumer price indexes or changes in interest rates, changes in gas pricing, international incidents, uh, how that will potentially impact both the real estate markets as well as the mortgage industry itself. So we'll be bringing that to you guys live. So I think there's a couple of Fed meetings scheduled before then. So we'll probably have a pretty lively discussion with it's our head of our capital markets and then our head of our securities department. So we'll be doing that. And then we've got another overview of AD Studio, which we just talked about. So that's a good deep dive instructional webinar put on by one of our experts on using the platform, and that'll help get everybody created there. And then lastly, if they're watching us on social media, then they're aware that we're on social media. But if they're not aware of other specific platforms, we do have presences on Facebook, LinkedIn, YouTube, something called Telegram, which is an app that's similar but a little bit more secure than WhatsApp. They can download it from Google Play or the App Store, and then just once they have Telegram installed, just go subscribe to ADMortgage_bot, and that's a handy all-in-one platform. It's a mix of a messenger service plus a news update, plus you'll be able to access pretty much everything on our website at the click of a button. And then lastly, there's Non-QM Exchange, which is a forum group that we moderate in partnership with other lenders. So it's more of an online community for brokers to discuss and find out things that are happening, both with competitors or what other lenders are doing, or they can put loan scenarios up, and I know that we are monitoring it pretty much like every 15 to 30 minutes. So if you put a scenario in, we'll get it over to somebody that could price it out for you. And then we often get the question about the learnings about the videos of these, recordings of these. Now they are being instantly recorded on Facebook and YouTube, so they'll be available as soon as we finish, as well as LinkedIn. If not, they can replay them there, but we'll record them and put them on our website as well. So if they've got our website bookmarked, they can just go to admortgage.com/learning-center, and this webinar plus all the other dozens of webinars we've done are there ready for on demand for them to learn. And lastly, the thing, if you're not an existing partner with us, I would encourage you guys to go to the website and start the process of becoming an approved broker. You'll find we've got typical for us is we've got some of the fastest turn times, competitive rates, great customer service. So that's 3 good reasons alone why they should want to be a partner with us. Plus, we're just good people. I think that's one that we never underscore enough. But I think we understand quirky borrowers because we deal with, and
A lender is a sum of the AE and his team.
Yes, and again, because we've got the backing of Imperial Fund, we are the sole proprietors of our underwriting guidelines, so we can accept whatever the risk is, make all the decisions, the exceptions. So yeah, I mean, it's a good time to. I know people are a little concerned about the current state of the market, but there are indicators that seem that things are turning the corner. So you're seeing, slight increases in inventory, which are lowering home prices, but still not enough that, it could fall under the conventional guidelines. Plus, you've got other world situations that are affecting it. So it's still very much a good time to be in the non-QM space. So if you have clients that are in the market, give us a call, start working with us. With that, I'll close this up. Renzo, thanks for a great, interesting discussion. Lots of good advice for our brokers and viewers. Just remember, for those people, go ahead and like, subscribe, and all the other ways that you can stay attached to us via social media. Again, I'm Carl Holman. We'll see you guys again next week, next Tuesday at 1 o'clock for our discussion on correspondent lending. So again, have a great day. Thank you for your time today. Thank you, Renzo.
Thank you very much. Have a great night.
You too, sir.